Welcome back to an unconventional approach to financial self-reliance. Today we're going to be focusing on becoming your own bank. Now, in a previous session, we talked about the conventional banking relationship, and I just want to review that. As a depositor, we put our money into a bank where it sits idle, and the bank has control of it. As a borrower, we borrow money out of the bank. We pay interest, which, of course, the bank is earning the interest, and they use the velocity of money to turn money over quickly and make more money from our money. Now, let's take a look at the possibility of becoming your own bank. Now, when I say become your own bank, I don't mean going out and applying for a charter at the state and acquiring a building and that kind of thing. I just mean, in principle, become your own bank. Now, we have the same relationship with our own bank as we do with a commercial bank, in that we are a depositor, as we said earlier. But in this case, as a depositor, what we're really doing is capitalizing our bank with our own funds. Now, earlier we talked about ways to recapture expenses, and we identified $83 a month. Well, let's say that we were to take that $83 a month and put it into our bank as capital. Now, this money would be the same as just finding money because we recaptured it without changing your lifestyle. So it's essentially the same thing as finding money. So we're going to take this found money, stick it in the bank, and at the end of the first year of capitalizing our bank, we have $1,000 in the bank. Now, let's say that, just for the sake of argument, that at the end of the first year, our refrigerator goes out and it needs to be replaced. And so we go down to the local appliance store and we identify the refrigerator that we want, and we ask how much it's going to cost, which, for the sake of this argument, let's say $1,000. And then we say, well, what if we were to finance this purchase? And the answer comes back $125 a month for 12 months. So now, instead of financing the purchase through the finance company arranged by the appliance store, we're going to borrow from our own bank because we have $1,000 in the bank. And so we're going to borrow that money and become the borrower from our own bank. Now, it's important to distinguish you as the individual from you as your bank, the entity which is your bank. You, the entity, you, the individual, are going to borrow the money from your bank. Okay, so you become the borrower. And now the important part of this, maybe the most important part, is that as the borrower, you're going to pay that loan back just like you would have had you borrowed the money from a commercial lending institution. And so you're going to pay it back with interest at the same terms, $125 a month. So at the end of the second year, you will have repaid your principal, the loan amount of $1,000, and you would also have paid $500 in interest. Now, in addition to that, we will have acquired an additional $1,000 in capitalization from the recaptured money of $83 a month. So at the end of the second year, you now have $2,500 in your bank. Now you're ready to loan money on a bigger project. Eventually, you can see that you can loan money for cars and even real estate at some point. The whole key to this is that you borrow money from your bank and then you pay it back to your bank. Now, this works with existing debt as well. In other words, you don't have to have an occasion, such as a refrigerator going out, in order to do this. If you have existing debt, you can capitalize your bank for a period of time and then use that money to take out an existing loan and basically refinance with your own bank. If you'd like to know more about this or any of the other principles of financial self-reliance, you can contact us at the information below.